April versus May I bonds, or 5-year tips or treasuries instead. Hello, Diamond NestEgg members, super savers, and course fans. I hope you're healthy and well. Our long-awaited I-bond projection for May is finally here. So, a little over a week ago, the Bureau of Labor Statistics, the BLS, published the March 2026 Consumer Price Index, or CPI. Over the last 12 months, the All Items Index increased 3.3% before seasonal adjustment, driven higher primarily by the war in Iran and oil prices. The Energy Index increased 12.5% for the 12 months ending March, while core inflation, less food and energy, rose 2.6% over the year. So still not quite at the Fed's target rate of 2%, but also not so bad in the grand scheme of things when we think about how far we've come since the post-COVID high of about 9% in June 2022. That said, the only thing we seem to know for certain these days is that everything is uncertain. And if matters in the Middle East drag on longer than expected, there is the possibility that inflation will also remain elevated for longer than expected. So it's no surprise that worries about price increases for everyday living expenses are currently top of mind again for some of our Diamond NestEgg regulars, especially for those who are already in retirement or planning on retiring soon. So with that in mind, here are the 3 topics that we'll be covering today. 1. What is our May I-bond rate projection? And would we personally buy now or wait? And in this section, we'll also cover the break-even time for those of you in our community who are considering redeeming your older, lower fixed-rate I-bonds to purchase new ones at the current fixed rate of 0.9% before the end of the month. 2. Who might want to consider the upcoming 5-year TIPS auction instead, or perhaps even nominal treasuries? And for those of you looking for safe and guaranteed, but potentially higher yielding alternatives to treasuries, we have section 3. How much higher are the current rates on multi-year guaranteed annuities, MYGAs, versus similar term treasuries? Let's dive in now, folks. What is our May I-bond rate projection? And would we personally buy now or wait? Let's begin with the I-bond fixed rate, because that's what many of you have been waiting for. As our Diamond NestEgg regulars have heard me say often, no one outside the Treasury really knows exactly how they set the I-bond fixed rate. For whatever reason, they seem to treat it like a state secret. But based on our analysis dating back over 2 decades, it appears that since 2015, if we take 65% of the average daily real yield on the 5-year TIPS for the 6 months prior to the I-bond rate reset date, this, together with a bit of rounding, gets us most of the time almost exactly to the fixed rate that is then announced by the Treasury. TIPS, Treasury Inflation Protected Securities, are the other type of inflation-protected debt that our government issues. As our Diamond NestEgg regulars and TIPS fans know, the real rates on TIPS that form the basis for our I-bond rate are set by the market, by the balance of supply and demand during the regular TIPS auctions. So let's calculate our projected I-bond fixed rate. The average daily real yield on the 5-year TIPS from November 1st, 2025 until close of market on Friday, April 17th, 2026 was 1.33%. Multiply this by 65% and we get to a projected next I-bond fixed rate of 0.87%, which we then round up to 0.9%. It seems that all I-bond fixed rates are always rounded to the next full 10 basis points. And this 0.9% is the fixed rate that we expect for all I-bonds that will be issued on or after May 1st, 2026 through the end of October 2026. This is the same as the current fixed rate of 0.9%, which isn't too bad given that real yields on TIPS have come down somewhat over the past several months. It clearly helped that this time we expect the Treasury to round up and not to round down. Now, let's move on to the projected I-bond inflation rate. Here we have the CPIU all items number from March 2026, 330.213. Divide this by the CPIU all items number at the end of September 2025, the starting point of 324.8. minus 1, and we get to this percentage change in CPIU over the past 6 months of 1.67%. Multiply this by 2, and we get to an actual annualized I-bond inflation rate of 3.34%, which is higher than the current annualized I-bond inflation rate of 3.12%. And of course, let's not forget about what we at Diamond NestEgg lovingly refer to as the bump, the inflation adjustment on the fixed rate, which is basically the projected I-bond fixed rate of 0.9% multiplied by the actual I-bond inflation rate of 1.67%, which gives us a projected bump of about 0.02%. So, to get to our projected combined I-bond rate for May, let's add together our projected I-bond fixed rate of 0.9%, our actual I-bond inflation rate of 3.34%, and our projected I-bond bump of 0.02%. This results in a projected combined I-bond rate for May of 4.26%, which is just slightly higher than the current rate of 4.03%, primarily driven by the higher actual I-bond inflation rate. This table may help with your decision on buying I-bonds now in April versus waiting until May or later. This column shows the month of purchase. This column shows you the fixed rate that you will get. The fixed rate stays the same for 30 years, the full term of the I-bond. This column shows you the inflation rate that you will get in the first 6 months after purchase. And this column shows you the inflation rate that you will get in the second 6 months after purchase. Remember that this inflation rate changes every 6 months. This column shows you the total bump on your I-bonds in the first 12 months after purchase. Again, the bump is the inflation adjustment on the fixed rate, so it changes with the inflation rate. And this last column shows you the combined or total I-bond rate you will get in the first 12 months after purchase. So, if you buy in April, you'll get a guaranteed fixed rate of 0.9% for the full 30-year term of the I-bond, but a lower inflation rate of 3.12% to start for the first 6 months. And if you buy any time from May until the end of October, you get this projected fixed rate of also 0.9% for the full 30-year term of the I-bond, but a higher inflation rate of 3.34% to start for the first 6 months. Now, as our VIP Investment Club members already know, Marcus and I are not buying I-bonds at this point in time. Not because we don't like them anymore. We do. I-bonds continue to serve a dual purpose in our portfolio as an inflation-protected emergency fund as well as inflation-protected retirement savings. But we've built up a good enough cushion of I-bonds with fixed rates above 0.9% for now, especially given how far away we are from retirement, and have decided to redirect the cash we would have otherwise spent on I-bonds opportunistically into other areas of the market. That said, if we were buying I-bonds this year, we would buy them before the May I-bond rate reset. Because even though the fixed rates look the same on paper, so to speak, regardless of when we buy, remember that this 0.9% here for I-bonds purchased and issued before the end of April is guaranteed, while this 0.9% here for I-bonds purchased and issued from May until the end of October is projected. Yes, the 0.9% fixed rate at the next I-bond rate reset is our best estimate based on our analysis of over 2 decades worth of I-bond data. And we've gotten this right over the past few I-bond rate reset cycles. But who knows, right? There may be other factors that Treasury Direct considers, which we are not aware of, that could lead to the actual fixed rate for May through October to be different from what we project here. In addition, buying before the May I-bond rate reset also means that at the time of purchase, I already know what I will earn on those I-bonds in the first year. My inflation rate for the first 6 months will be 3.12%. My inflation rate for the second 6 months will be 3.34%, the same 3.34% I would get if I were to purchase my I-bonds between May and October. Meaning that when I average out these two inflation rates, add on my small bump in the first 12 months of 0.03% and add on my guaranteed fixed rate of 0.9%, I know that in the first 12 months, I will earn about 4.16% in total on any I-bonds that I buy before the May I-bond rate reset. If I buy during the May through October period, my I-bond fixed rate may likely be the same. And while I am starting off with a higher inflation rate for the first 6 months, I don't know yet what my inflation rate will be for the second 6 months, meaning that I also don't know what my bump and my total I-bond rate for the first 12 months will be. As the old adage goes, a bird in the hand is worth two in the bush. And to say it again, because apparently the Lammers are a repetitive bunch, the new I-bond rates we've discussed today are expected to go into effect for all I-bonds issued on May 1st or later. So to still get these numbers here, if that's what you want, you will need to make your I-bond purchase before April 30th, meaning on April 28th or April 29th. Or possibly earlier if you want to be on the safe side, because Treasury Direct needs at least 1 business day to process I-bond purchase orders. If you buy your I-bonds on April 30th or later, you will get the May I-bond rate. Now, if you're still undecided at this point, another option to consider is to split up your I-bond purchase. For example, buy $5,000 of your $10,000 annual limit before the end of the month to lock in the current rates, and buy another $5,000 after you know what the May I-bond rate will be. Or come join our private VIP investment club and continue the conversations with me, Marcus, and our other VIP members, and see what others like yourself are doing right now to hedge against inflation and grow their nest egg. Visit our website at www.diamondnestegg.com and click on this yellow private VIP investment club button to learn more about the latest happenings in our growing member community. I've linked everything below this video for you as well. So, I-bonds. Remember that for I-bond purchases, regardless of whether you buy at the beginning of the month or the end of the month, you will get interest for the entire month that you purchased your I-bonds in, meaning that even if you buy your I-bonds in the last week of April, you will get your I-bond interest for the full month of April. And now we'll answer the question for those of you who've asked about what the break-even time might be if you decide to redeem your older, lower fixed-rate I-bonds that you've held for less than 5 years to purchase new ones at the current fixed rate of 0.9%. For old I-bonds with a 0% fixed rate, the break-even time is 10 months. Or, in other words, it makes sense to redeem and reinvest your old I-bonds with a 0% fixed rate if you're planning on holding them for more than 10 months, because you will start earning an extra return on your investment after these 10 months. And by the way, you'll have to hold your newly purchased I-bonds for more than 10 months anyway, because the minimum holding period for newly purchased I-bonds is 12 months, so you won't be able to redeem them before that. For old I-bonds with a 0.4% fixed rate, the break-even time is about 21 months. Do note that I-bond redemptions always consist of principal and the prorated interest amount, and in the year of redemption, taxes may come due as part of that interest. You cannot choose to withdraw only principal or only accrued interest. It'll always be a prorated mix of the two. For the purposes of our break-even analysis, we assume that the redeemed amount for reinvestment is the net amount after tax. There are a few other assumptions that we've made in our break-even analysis, as well as additional considerations to take into account if you're considering redeeming your older, lower fixed-rate I-bonds that you've held for less than 5 years to purchase new ones at the current fixed rate of 0.9%. If you want to learn more about these assumptions and or considerations, please check out this I-bond break-even analysis video from last year, linked below in the first pinned comment for your convenience. And don't forget that your usual annual purchase limit of $10,000 per Social Security number or EIN will apply, even if you sell old I-bonds before. There's no special exemption for such an upgrade. So, now that we've covered everything I-bonds, let's move on to the next section of today's discussion for those of you who are contemplating the I-bonds versus TIPS decision. Who might want to consider the upcoming 5-year TIPS auction instead? Or perhaps even nominal treasuries. So the 5-year TIPS auction will be taking place this coming week on April 23rd. At the time of this taping on Fidelity's platform, the expected coupon is 1.125%. and the expected yield is 1.18% for the 5-year TIPS auction. Please keep in mind that these estimated numbers on Fidelity's platform can and usually do change all the way up to the time of the auction. Now, the expected yield at the moment for the 5-year TIPS auction is a bit lower than the average real yield of 1.4% over the past 12 months, but still higher than the 5-year average real yield of 0.92%, and also higher than the current I-bond fixed rate of 0.9%. So, if you're comfortable with TIPS, this may be something to take a closer look at. Remember, though, that whereas I-bonds are pretty much straightforward, TIPS, like the annuities that we talk about regularly on this channel, can get complex and fast, especially if you need or have to sell those TIPS before maturity. That said, for the right investor who's willing to invest a bit of time to understand them, they may be worth the effort, as TIPS, like annuities, offer something that's not easily available from other investments. Bond beginners, folks, please refer back to these 2 modules here on TIPS and I-bonds for a refresher. For those of you who are not in our bond courses, I've linked some of our YouTube videos on TIPS and I-bond basics below this video for you as well. So personally, Marcus and I are quite comfortable with TIPS. And if we were making the I-bonds versus TIPS decision today, at the time of this taping, for a 5-year time horizon, and we could only choose one of them, we would probably lean towards the 5-year TIPS auction, given its higher real yield over the current I-bond fixed rate. For those of you who are making the 5-year TIPS versus Treasury note decision, do note that the break-even inflation rate on the 5-year TIPS was about 2.6% at the close of market on Friday, April 17th. This is higher than the average break-even inflation rate of about 2.4% over the past 5 years, which should come as no surprise given that the latest inflation report from the BLS showed annual inflation coming in at 3.3% overall at the end of March, and core inflation coming in at 2.6%. So, if the 5-year TIPS fits your timeline, goals, and expectations, and you want to add some inflation protection because you believe that inflation over the next 5 years will average more than 2.6% annually, for example, because you believe that the war in Iran will drag on and or prices will stay elevated, and you're comfortable with the complexity, overall lower liquidity, and tax nuances of TIPS, then this may be an option to consider dollar cost averaging into. If, on the other hand, you believe that inflation over the next 5 years will average less than 2.6% annually, then you may want to skip the 5-year TIPS auction this time around and redirect that money towards a 5-year T-note instead, assuming that is the timeline you're working with and it suits your personal situation. As of close of market on Friday, April 17th, here's where the nominal yield on a 5-year T-note stands, at 3.84%. For our VIP Investment Club members, we will be posting an update on what all the expected numbers for the 5-year TIPS auction look like after the market closes on the evening before the auction. As always, we'd love to invite all of you into our growing member community, where we have daily discussions and share ideas on what everyone is investing in right now for safety and inflation protection, as well as for higher yielding growth. Visit our website at www.diamondnestegg.com and click on this yellow Private VIP Investment Club button to learn more. So, now that we've covered I-bonds and TIPS, let's move on to the next part of today's discussion for those of you who are less concerned about inflation and more focused on safe, predictable, and guaranteed nominal yields. How much higher are the current rates on multi-year guaranteed annuities, MYGAs, versus similar term treasuries? For this comparison, we'll focus specifically on rates for multi-year guaranteed annuities, MYGAs, from an A++ rated insurance company that we work with. A++ is the best credit rating that an insurance company can get from AM Best, which is a ratings agency that specializes in the insurance industry, meaning the lowest risk, making the MYGA rates that we're about to cover most comparable to Treasuries in terms of risk-return profile. And remember that MYGAs work essentially like a CD, similar to a bond, except that MYGAs do not pay interest regularly, but accumulate it in the MYGA account and pay out everything together at maturity. Longer-term MYGA rates continue to move higher, which is consistent with some of the rates on medium and longer-term treasuries. So let's begin with some sample rates for MYGAs. Here you have the investment amount for each investment range, from $10,000 all the way up to just under $10 million. And here's the rate for a 2-year MYGA, 3-year MYGA, and so on, all the way up to 7 years. For example, if you were to purchase a $10,000 7-year MYGA at the time of this taping from this A++ carrier, your rate might be 4.5%. A $50,000 7-year MYGA might earn you 4.6%. A $100,000 7-year MYGA might earn you 4.75%, which is quite good actually. And a $1 million MYGA might earn you even 4.8% for 7 years. And if you have more than the amounts shown here, say north of $10 million, your rate might go as high as 4.9% with this A++ insurance carrier this coming week. Do keep in mind that the MYGA rates in this table are subject to change at any time without prior notice, and that your personal rate is not fixed before you sign your annuity contract. For the latest rates whenever you're watching this video, and to see if a MYGA or some other type of annuity may be a good fit for you, email us at jennifer@diamondnestegg.com so that we can connect you with our trusted annuity specialist. Now, let's move on to Treasuries. There is usually a $1,000 minimum for Treasury transactions with most leading brokers, like Fidelity, Schwab, and Vanguard. Treasuries are more liquid than MYGAs because you can sell them before maturity on the secondary market at whatever the then prevailing market price may be. Do note that MYGAs usually only allow you to withdraw some part of your capital per year without penalty. For example, 10%. This liquidity advantage of Treasuries over MYGAs is also one of the main reasons why Treasury rates are normally lower than MYGA rates. As this table shows, the rates on Treasuries range from as low as 3.71% for a 2-year term up to 4.04% for a 7-year term. And as our VIP Investment Club members already know, for a 2-year term, you're now a bit better off with the Treasury than a MYGA with this top-rated insurance carrier. For anything longer than a 2-year term, the MYGA rates continue to outpace Treasury rates, which is to be expected. Just make sure that you are comfortable with the illiquidity of MYGAs, their lack of regular interest payments, and the possible early withdrawal penalties before the term ends or before you turn 59 and a half prior to diving into any MYGA investment or any annuity investment for that matter. And of course, while both MYGAs and Treasuries offer safe, guaranteed, and predictable income, neither of the two protects against inflation. That would be a job for I-bonds and TIPS, as we discussed before. Annuities come in many different flavors, so be sure to check out these annuity videos here, all linked below this video, if you want a deeper dive into who should buy a MYGA, some other type of annuity, or no annuity at all. Or email us at jennifer@diamondnestegg.com to get connected with our trusted annuity specialist, as I mentioned earlier. All right, Diamond Nest Egg members, super savers, and course fans, I hope you enjoyed today's video and learned something new. And see you again very soon with more brand new wealth building content for your financial journey.